Picture this: a small town in Nebraska, a young boy sitting at a kitchen table, flipping through financial newspapers, jotting down stock prices, and dreaming of a future most thought was out of reach. Warren Buffett, at just 11 years old, was already obsessing over the idea of making money. But how did this small-town kid, armed only with an unshakable curiosity and an incredible knack for numbers, turn that dream into a fortune worth billions? Today, let's take a look at how Warren Buffett made his first $1 million and what it can teach us about the power of patience, knowledge, and calculated risk. Before diving into the specifics of Buffett's first million, let's take a moment to set the stage. Warren Buffett was not born with a silver spoon in his mouth. He was born in 1930, during the Great Depression, in Omaha, Nebraska. His father, Howard Buffett, was a stockbroker and later a U.S. congressman, but the Buffett family wasn't wealthy by the standards of today's billionaires. Despite this, the young Buffett was already displaying an extraordinary fascination with business, entrepreneurship, and finance. At an early age, Buffett didn't just look up to his father, but also to a legendary investor who, years later, would become his mentor, Benjamin Graham. Known as the father of value investing, Graham's approach to the stock market was revolutionary. He believed in buying stocks that were undervalued, or in other words, stocks that were on sale but had long-term potential. This mindset would shape Buffett's strategy throughout his life. So, how did Buffett go from this small-town kid to making his first $1 million? Let's break down the key moments that made it happen. The first steps: early hustles and investments. Buffett's first business venture didn't involve stocks at all. It was a simple yet effective hustle. At age 6, he sold chewing gum, Coca-Cola, and newspapers to his neighbors. By age 11, he was already a budding entrepreneur, using the money he earned to buy his first shares of stock. His first stock purchase came at the age of 11, with an investment of $114.75 in 3 shares of City Service Preferred. The shares were priced at $38 each, and Buffett thought they were a bargain. But like any stock, they didn't perform as expected. The price dropped to $27 per share, and young Buffett panicked, selling the shares at a loss. But soon after, the stock price surged back to $40. It was a painful lesson for him, teaching him the importance of patience and understanding the volatility of the stock market. This early experience, though a loss, helped shape Buffett's investment philosophy. The key takeaway? Long-term success in investing doesn't happen overnight. It's about staying calm during the storms, keeping your eyes on the prize, and making decisions based on the fundamentals, not short-term price fluctuations. The breakthrough: moving toward bigger deals. Buffett's teenage years marked the beginning of his serious commitment to investing. By 16, he had saved up enough money to buy a used pinball machine for $25, which he placed in a local barber shop. Soon, he had more machines, and his business was thriving. This was his first taste of real business success, and an early example of how he could make money work for him. But it wasn't just pinball machines that shaped Buffett's journey. In 1947, Buffett enrolled at the University of Nebraska and later attended Columbia Business School, where he studied under Benjamin Graham. It was here that Buffett's investment philosophy truly started to take shape. Graham's principles resonated with him. The idea of buying undervalued stocks, looking for companies with strong fundamentals, and most importantly, being patient with your investments. After completing his education, Buffett returned to Omaha and began working for a firm called Graham Newman. But he didn't stop there. Buffett was already thinking big and looking for opportunities beyond traditional brokerage firms. The big leap: the birth of Buffett Partnership Ltd. By 1956, Warren Buffett had saved enough money to launch his own partnership, Buffett Partnership Ltd. He pooled money from family, friends, and a few investors, and with this capital, he began to invest in undervalued stocks, just as Graham had taught him. The returns were phenomenal. Buffett had a knack for finding companies with real potential that others overlooked. But it was in the early 1960s, when Buffett acquired a struggling textile company called Berkshire Hathaway, that his first $1 million started to feel within reach. Buffett had no intention of running a textile business for the long term, but he saw the potential in the company's assets and management. Slowly but surely, Buffett started to shift Berkshire Hathaway into an investment vehicle, buying stakes in businesses that were undervalued and underappreciated by the market. It It was around this time that Buffett made a move that would change his career forever. He partnered with Charlie Munger. The partnership, Munger and Buffett's dynamic duo. In 1959, Warren Buffett met Charlie Munger, a lawyer and investor with a sharp mind and a contrarian perspective on investing. The two clicked immediately. Munger, who had his own investment philosophy, was a breath of fresh air for Buffett. While Buffett had focused heavily on value investing, buying stocks at a bargain, Munger brought a new perspective, investing in high-quality companies that were undervalued but had strong growth potential. Munger was more interested in buying great businesses at a fair price than fair businesses at a great price. Buffett, ever the student of great minds, quickly realized that Munger's approach was complementary to his own, and they began to work together. By 1978, Munger had joined Buffett at Berkshire Hathaway, and their partnership began to reshape the company and its investment strategy. One of their first big joint decisions was to invest in See's Candies, a company that had a simple business model but incredibly strong brand loyalty. While See's was not the cheapest company to buy, Munger convinced Buffett that it was a business worth owning for the long haul. It was a move that would prove to be one of their best decisions. See's Candies not only provided steady cash flow but also showed Buffett and Munger the power of investing in businesses that had a strong competitive advantage and a loyal customer base. This partnership marked a turning point in Buffett's strategy and his path toward making his first $1 million. With Munger's influence, Buffett shifted his focus to businesses that had sustainable, long-term profitability, and the results were clear. By 1969, Buffett was officially worth over $1 million, and Berkshire Hathaway had begun its transformation into the investment powerhouse it is today. The moment of triumph, the $1 million milestone. It wasn't until 1969 that Buffett officially crossed the $1 million mark in net worth. By that time, Berkshire Hathaway had grown significantly, and Buffett's investments in other companies, such as American Express, Washington Post, and See's Candies, had paid off handsomely. But Buffett's rise to his first million wasn't just about making good stock picks. It was about sticking to his principles. He didn't chase the latest trends or get swept up in the frenzy of the stock market. Instead, he invested in businesses he believed were undervalued and had the potential for long-term success. And when he found a company that met his criteria, he was patient. Buffett's investments weren't about quick wins. They were about steady, sustainable growth over time. This commitment to his strategy eventually paid off. By the time he reached his first million, Buffett had already established himself as a serious player in the world of finance. He had the knowledge, the discipline, and the patience to take on bigger risks, and he was beginning to see the rewards of his efforts. Warren Buffett's journey to making his first $1 million wasn't about luck. It was about patience, strategy, and the relentless pursuit of knowledge. By teaming up with Charlie Munger, Buffett found a partner who pushed him to evolve his investment approach, allowing him to see the long-term potential in businesses and investments others might have overlooked. With that said, thanks for watching, and until next time. Don't forget to subscribe, like, and share.